I'm here with a quick lesson on an option strategy that has worked for me in the past and one that's consistently profitable in a good way to double your money almost every single month. If you do it the right way, then you should be right on your trade about 80 or 90% of the time. So here we're on Thinkorswim. It's the platform that I choose to use. It's just worked for me in the past. I like the way that it looks in the setup. So first I'm going to go over the kind of studies that I use for looking at this pattern and when to enter this type of trade. So first we'll hit our beaker here, go into edit studies, and I like to add DMI. We'll add the RSI, MACD, and then two most important ones. One is Keltner channels, and the other one is Bollinger Bands. And we apply those, and this is what you get. All right, so essentially this is a vertical spread strategy. If you don't know what that is, I'll go ahead and show you. We'll go into our option chain here, and let's say we're bullish on Microsoft and we want to enter a vertical spread. What we'll do is we can choose any one. Let's just choose one strike in the money here. We'll right click, go over buy, vertical. Thinkorswim makes it super easy to do. All right, so essentially what you're doing is you are buying a call and selling another call that's a little bit more at the money or one strike further out of the money for the same expiration date. All right, so the way that it looks like on an actual chart here is this is what you get. So let me delete one of these. And this is essentially what you get. Now on Thinkorswim, when you do your risk profile, this blue line here shows you your profit at expiration. So if you let the contract go all the way out to expiration, and this pink line here shows you what your profit would be at the date that you have set. So it takes into factor, your time decay and all of your option Greeks. So what we can do here, and as you can tell, is when we have our price slices, let's go all the way out right here. This is a September 18th contract on Microsoft, and we'll go all the way out to day after expiration. And as you can see, this contract is going to cost us $323, and our profit is $177, and that's our max profit. Now, if we did one at the money, if we bought an at the money call and sold one that was one straight out of the money, then it would more or less double our money. Let me show you here. So if I do the trading at 209.19, so our 205 strike is our at the money contract here. So if I do a vertical, it's going to cost us $272 per contract. And if I analyze this trade, as you can see, as long as I go up 1%, then I maximize my profit at 225, and we spent 275 per contract. So what I'm looking for when I enter one of these trades is on Microsoft, it's not a good time, in my opinion, to go into one of these trades, and I'll explain to you why. I can get this thing to come down. Okay, there we go. So what I'm looking for when I enter one of these trades is for my Bollinger Bands, which is this red line here and this pink line down here, to be outside of my Keltner channels. And this middle Kelt right here, this blue line, represents a mean price. It's an average price. And essentially, the price of your underlying stock will always come back to this middle Kelt line. And when I'm entering one of these trades, I make sure that our earnings are about 30 to 45 days out. And I don't want to enter a trade where my expiration is after earnings. The reason being is our implied volatility typically gets crushed during this time. There's different strategies you can do if you want to play coming up to earnings to capture some of that implied volatility before it happens. But using a vertical spread, I typically stay away from earnings or any expected news coming out. If they have any big plans, we try to stay away from chasing the news and stuff like that. But essentially, what I'll look for is when our price gaps up like this. When it gaps up and we're at the top of our Kelt, enter here into a put spread. So that I showed you a call spread. You can also do a put spread, and it just does the exact opposite. So I can change this to a sell, right? And that's the same thing as doing a vertical put spread, buying a vertical put spread or selling a vertical call spread. So when I enter up here, it's always going to come back down to this middle Kelt. As you can see, back here goes way out, back down, up and back down, up and back down to the middle, or sometimes even down to the bottom Kelt. And that's really what we're looking for. But what we really want to do when we enter this trade is wait for a gap up like this. And the only reason that the underlying stock gapped up or is at the top of the Kelt is because it's following the rest of the market. It's following the Dow Jones, S&P 500, and the Nasdaq. All of our futures are up like crazy, and that's the only reason why our stock is up. It's not trading at its average price anymore. It's trading up just because there's a lot of buying going on, and the market is very bullish. So that's when we would enter if we're bearish, that's when we would enter a put spread, and vice versa. If the market is down and the stock you're looking at is down just following the rest of the market, then we could enter a bullish call spread. So when we have a gap down, then we enter that vertical call spread and try to capture as much profit as we can going back up to that middle Kelt or the top Kelt, because it's eventually going to go back to that within that next month or so. And after earnings, we stay away from earnings. Now, when we want to exit this trade, we would exit once one of two things happen. So if we look back at our risk profile, let's go to today is August 11th. Let's say at the end of next week, Microsoft makes a 10% move, and we have $166 profit. It's not a bad idea to exit at that point and just take your profit. But otherwise, we would just stay in until our expiration date hits, and we maximize our profit. But it's not a bad idea if you want to capture 50%, 60, 70% of your profit early. Now, the only reason I would exit one of these trades early is if it went down 50%, because we're really looking to double our money on one of these trades. So if we're only going to lose 50%, we know that the next one we're going to double our money. So it's really a 2-for-1, exiting at 50%. I typically don't use a stop loss on these type of trades or any type of trailing stop. Typically, I just watch it, and if I see that I'm down 50%, I'll exit and try to find something else. So there's a quick lesson on a strategy that consistently works for me as a vertical spread. And if you have any questions, feel free to private message me and let me know what other type of content that you want to see, what other kind of lessons that you would like to see. And I'll be more than happy to make a video and explaining some other strategies that I use. But I will be posting some more videos as far as different strategies that I use, how to protect your losses, and what you can do in order to not be constantly watching your options, because the price does change so quickly. Again, if you have any questions, go ahead, reach out to me. I'd be more than happy to answer any questions that you have.